Look at the global financial system as a physical structure. It expands through architectures of debt and leverage, but systemic shocks reveal its mathematical fragility. At the institutional level, the threat taking down these structures is credit risk, the financial loss when a borrower fails to meet contractual obligations. For most commercial banks and non-banking financial companies, it is the single largest risk category on the balance sheet. Absorbing these potential defaults typically consumes 60 to 75% of an institution's required regulatory capital. Lending money requires institutions to measure the unmeasurable, human and corporate behavior. To survive, a bank cannot just guess who will pay them back. They have to engineer quantitative models that accurately predict uncertainty. The entire architecture of modern banking rests on one foundational equation. Expected loss equals probability of default times loss given default times exposure at default. Mastering these three variables is the only way a financial institution can objectively price its loans, calculate its required cash reserves, and prevent insolvency during a recession. This chart maps credit bureau scores on the horizontal axis against a default probability percentage on the vertical axis. It represents probability of default, or PD. This is the exact statistical likelihood that a specific borrower will stop making scheduled payments within a given time horizon. For a standard performing loan, banks typically look at a 12-month PD to assess immediate risk. If a borrower shows signs of financial stress, risk managers switch to a lifetime PD, projecting the cumulative risk of default over the remaining life of the loan. If that default actually occurs, the equation moves to loss given default, or LGD. This timeline shows a default event, the subsequent liquidation of collateral, and the deduction of recovery costs. LGD is the percentage of the exposure permanently lost after all recovery efforts are finished. The final loss percentage shifts based on the quality of the collateral, the seniority of the bank's claim, and the efficiency of the local insolvency regime. A longer workout period mathematically guarantees a higher discounting loss. This chart tracks a distressed corporate borrower, illustrating the final variable, exposure at default, or EAD. EAD is rarely just the current outstanding balance. As a company heads towards insolvency, it typically draws down cash from previously unused credit limits to stay afloat. To capture this behavior, banks apply a credit conversion factor, or CCF. It predicts what percentage of a borrower's undrawn commitment will be converted into hard debt right before they go under. By isolating the likelihood of failure, the severity of the loss, and the total money at risk, a bank builds a functioning risk engine capable of evaluating millions of distinct exposures simultaneously. Regulators require empirical proof that these theoretical equations accurately reflect historical reality. These models only gain institutional trust once they pass rigorous statistical validation. This distribution model illustrates discrimination, a model's ability to rank order high-risk versus low-risk borrowers. The two curves represent good and bad accounts, and the vertical line measures the maximum separation between them. That separation is quantified using the Kolmogorov-Smirnov statistic. Alongside the Gini coefficient, these metrics mathematically prove whether a bank's scorecard can effectively distinguish between a reliable business and a future default. Ranking risk is insufficient on its own. Models also require calibration. This tests how closely the predicted probability of default matches the actual observed default rate in the real world. If a model predicts a 2% failure rate and the actual rate is 5%, the calibration has failed. Analysts also track the Population Stability Index, or PSI. This measures whether the current pool of applicants is shifting away from the demographic data the model was originally trained on. If a risk engine fails these statistical validation checks, the bank will misprice its loans, approve the wrong applicants, and slowly erode its balance sheet from the inside out. A well-calibrated model works reliably under normal conditions. But risk mathematics must account for what happens when reality suddenly deviates from the average. This graph is a loss distribution curve. It serves as a map of an institution's vulnerability. The horizontal axis represents the total loss amount, and the vertical axis represents the probability of that loss occurring. The thick middle section of the curve represents expected loss. These are the routine, average losses the bank anticipates as the normal cost of doing business. The long, thin right tail of the curve represents unexpected loss. This area captures extreme volatility, deep recessions, and systemic shocks that defy standard averages. Regulators mandate that banks hold enough capital to survive these massive tail risk events. They draw a mathematical line far down the right tail, typically at a 99.9% confidence interval. The bank must handle these two zones differently. Expected loss is covered proactively by charging interest to borrowers and setting aside accounting provisions. Unexpected loss can only be absorbed by the bank's actual equity capital. Confusing expected loss with unexpected loss is fatal. If a bank uses its equity capital to cover routine daily losses, it will have nothing left to absorb the shock of a systemic macroeconomic crash. Because expected and unexpected losses serve different purposes, the professionals tracking them operate under different paradigms. A bank's accountants and its regulators often disagree on how to measure the exact same loan portfolio. This division requires a dual framework architecture, contrasting accounting standards like IFRS 9 with global regulatory frameworks like Basel III. The IFRS 9 accounting standard mandates a forward-looking, point-in-time approach. It requires banks to use current macroeconomic scenarios to calculate expected credit losses from day one. In this flowchart, you can see a loan migrating from a 12-month expected loss in Stage 1 to a lifetime expected loss in Stage 2. That migration is triggered by a significant increase in credit risk. If a borrower breaches a covenant or the broader economy deteriorates, the accounting model immediately pulls forward the lifetime probability of default. The Basel III regulatory approach relies on through-the-cycle data, taking a long-run average of default probabilities that stays stable even during economic booms. It pairs this with conservative downturn LGDs that assume collateral values will crash during a crisis. The regulator takes these smoothed, pessimistic inputs and feeds them into the internal ratings-based formula to calculate the bank's total risk-weighted assets. This dichotomy is deliberate. Accountants are legally bound to reflect the accurate present-day reality of the portfolio. Regulators are engineering severe, cyclical buffers to ensure the bank survives a hypothetical doomsday. These mathematical frameworks do not exist as static documents in a compliance file. Credit risk functions as an active, continuous feedback loop. On trading floors and inside portfolio monitoring units, quantitative outputs are constantly tested against live financial markets and borrower behavior. This chart displays vintage curves, tracking cumulative default rates by origination quarter. Isolating cohorts reveals if recent loans are performing worse than older ones. Paired with early warning signals like delayed payments, banks flag deteriorating accounts months before actual default. All of this monitoring data feeds into the ultimate goal of the entire risk architecture, risk-based pricing. It is calculated using the risk-adjusted return on capital, or RAROC formula. The interest yield charged to the borrower must generate revenue that covers expected loss provisions, while delivering an adequate return on economic capital reserved for unexpected loss. This pricing data loops directly back to the origination desk. The actual recoveries and losses inform the next generation of probability models, tightening the underwriting criteria for the next borrower. Credit risk management mathematically optimizes uncertainty to maximize the efficiency of a financial institution's balance sheet. It transforms risk from a passive threat into a tool for mathematical optimization.